Good morning, ladies and gentlemen. Good morning. Welcome to Module 4 of the DTB Personal Financial Literacy Training in collaboration with Zurich Consulting. Welcome, welcome. Karibuni sana to Module 4. Please say hello in the chat, even as we join the call. Thank you, Rogers. Good morning. I hope you are all doing well and energized for the session today. Today is Module 4. We have been on a 4-week journey so far, and the commitment has been great. Thank you. Let's go. Yes, Evans. So Module 1 was on debt management strategies, and then we went into investments. So after, organizing our finances well and ensuring that from a debt point of view that we have put timelines and have put everything in order, we went into investments. We had part 1 and 2, and last week we covered equities and collective investment schemes. We got to know more about shares and even in the real estate space and the different investment types that we could get into. And one thing that came up towards the end of last week is that now that you've, gotten a bit more information and a plan on how you can go about your investments, now we need to start thinking about our retirement. And so today's Module 4 is on planning for retirement. And even before I welcome Brian, who will take us through today, and Elizabeth, I just want to ask a very random question. Is that where would your ideal place of retirement be and why? So you could share in the chat. Let me start with the dreams before we get into reality and how to get there. So where would your ideal retirement place be and why? It would be great to hear. Is it, by the beach? Is it by the mountains? Is it we shall go with your cows and chicken, or in the city? We would love to hear. So karibuni sana. We see you coming in. Good morning, all of you. Yeah. So even as we wait for those answers, we have Brian today, who is our financial wellness and investment expert. He has been here before, and we can't wait for the good things in store. We have Sheila saying by the beach, Tab saying ideal retirement is away from the city, ranch vibes. We have, it's coming in. So we have large ranches around Nanyuki. This is Amagira. Eric is by the beach. Rogers is my rural home would be so therapeutic. It's coming in. We love it. In Shags with some cows, that's Ida. Priska is the farm. Hey, no one wants to continue in the city. Evan says, I see myself in a beautiful garden with the music. Nimeona mkono wake bwana. Amen to that. Patricia is farming and traveling. Great. Good stuff. Good stuff. So Brian, you can see the vision that we have from our participants. And so before Brian begins, maybe Elizabeth, you can let us know what to look forward to in today's session, and then we can have Brian take us through. Karibuni sana.
Thank you so much, Manchu. It's always a pleasure to have this session and catch up with what we want to do, where we want to be. And I think even as Manchu asked about where do you want to be, the question is with who and with what money and what will you be doing with your 24 hours, You'll still be having 24 hours, you're healthy. So we need to think about all those as they come in. So today, Brian is going to take us through what are the vehicles that are available for us to achieve whatever we want. And we will definitely remain very engaged. So ask as many questions as possible, how you can make your money work for you, even as you plan for retirement, and what advantages that are there in the pension industry. So happy to have a good conversation. And even as we continue, it will be good to be on week 4. Even as we continue, we would like to see what changes have you done in your life when you think about debt management. Did you go list all the debts? Did we start paying off the most expensive ones? And did we consolidate? When you talked about the various investments, have you opened that money market fund with a brand that you care for so that you're able to start? Because remember, retirement planning, all what you have been doing is really a build up to the retirement planning. So over to you, Brian, as we think about where our journey is and what has changed over the last 4 weeks. So Brian, over to you.
All right. Thank you very much, Elizabeth. Thank you, Matui and the GTB team. Happy to be here. So yes, as Elizabeth has said, we've gone in process from when we started with managing our debt, sorting out the short-term obligations, then going into investment, which is the medium-term obligations, learning about our different investment options. So now we are looking at long-term planning for retirement. So I'll be taking you through retirement planning, and I'm sure all of us here have thought about retirement. I can see very, very good ideas about where we want to retire. I've seen someone who has my exact plan, wanting to retire in a ranch somewhere in Nanyuki, away from the hustle and bustle of the city. So I see there's a lot of us who are already thinking about their retirement and planning for their retirement. So we'll be able to now see how do we go about that? How do we ensure that our money works for us even in the long term, even as we're thinking of our retirement plans, and also how to get to secure our future. So please feel free to put all your questions and comments in the chat box. We'll be very happy to engage and discuss with you because we are all learning from each other here. So I'll start with our presentation. Start by putting out a question similar to what we had mentioned about where you want to retire, but this is in a different vein where we are looking at. Imagine your first month without a salary. Let's say you've retired and the salary is not forthcoming anymore. Bills continue to arrive. So if you had to pay everything from your savings for 12 months, would you be able to do that? And would you be able to do that also calmly without having to maybe sell off some of your investments, without having to restructure completely your finances in a manner that you're able to handle? So that's food for thought. Feel free to put it in the chat box if you want. And then another question also for us to just think about where we are. If your salary stopped today, how months can you cover from cash? So are you able to, with the amount that you have saved up without having to go into debt, would you be able to cover yourself, and for how many months would that be? And then the third one, when you're thinking about your retirement, there's a number of things that will affect your retirement portfolio and the kind of savings that you're putting away for retirement. So you'll have your inflation, you'll have your medical costs, because as you're growing older, you end up getting more medical conditions that you need to attend to and that cost you money, or that cost you higher premiums in insurance. And then also market changes. The market could drop and affect your portfolio. So you have to think about where you're saving and how that is going to be impacted by market movements. So by thinking about all this, we're able to position ourselves and see where are we as when it comes to retirement. Are we in a position where we are more comfortable and we are in a place where we can comfortably retire, or does it mean that we need to do a bit of work into our retirement? So I think for most of us, it will emerge that perhaps you need to do a bit of work. And also, if you've been doing something, you want to do something a bit extra. So in this presentation, I will be able to tackle and see what are these options that you have and what is best placed for you to pick as a retirement planning option. So we'll start by understanding the definition of retirement through some of the pillars that we consider the pillars of retirement planning. So as we all know, retirement is when you stop depending on a monthly salary or your business income, and start depending on your pensions and passive investments. So good planning creates reliable inflation-aware income. It also protects your health and secures your family. So even when you're gone, your beneficiaries will continue being protected. And there's three main pillars that we look at when you're looking at retirement. You're looking at your income. So are you able to ensure yourself that you have a steady cash flow now that you're not dependent on a salary, or you're not collecting revenues from a business that you are actively managing? So are you able to ensure that you still have a steady cash flow that sustains you? In terms of health, well, as you've mentioned, your health costs are going to go up as you grow older because some conditions happen as you grow older. So you'll have to prepare for that, and you'll have to be prepared for any eventualities. So are you able to budget properly for medical cost and insurance, and also have a buffer in case of any unforeseen medical expenses that perhaps could not be covered by your insurer? And then also, in addition to that, when you're at your retirement stage and you're thinking about that retirement stage, you're also thinking about your legacy. How are you going to live when you leave this earth? What are you going to leave those who come behind you, your dependents, your beneficiaries? Are you going to ensure that there's a smooth transfer of assets to them? Are you going to ensure that they're protected, that they're not going to be, their standard of living is not going to be affected by your death? They're going to be protected even in that eventuality. So by thinking about those three pillars, you're able to now do proper retirement planning. And we'll go into these pillars and see how you protect yourself on each of those pillars step by step. So even as you're planning for retirement, we have to understand some of the risks that you're likely to encounter as you are building your retirement portfolio. The first risk that you will see is inflation, because prices rise over time. Your income right now, let's say you're living on, on 100,000 per month. If that 100,000 per month, looking at it 20 years down the line, 25 years down the line, even 10 years down the line, is not going to be able to service you the same as it does now. So that means even as you're planning for your retirement, you're supposed to think about what is going to be the value of money as I'm growing older? Is this able to sustain me and those increased expenses even in my old age? And as the value of money continues to deteriorate, because even after you've retired, the value of money will still continue to deteriorate. So you'll need to ensure that you're planned effectively for that. Then you also have to think of longevity, how long you will live after your retirement. These days, let's say retire at the age of 60. These days, with improved healthcare and improved standards of living, people are living much longer than they used to. And so with that, you have to think about, are you able to live much longer on that pension? Perhaps people lived on their pensions for 25 to 30 years. Maybe you live on it for 40 years even. So you have to start thinking about factors like that. Are you able to plan properly for that? Then there's also the impact of what you call sequence risk or market risk. So for example, you might have saved your retirement portfolio in somewhere, maybe you've bought some shares somewhere, and then the value of those shares drops significantly. So that means if you face that loss early on in your retirement, you've sort of affected the value of portfolio over time. So you have to think about that, and we'll see how you're able to hedge yourself against such risks. And then you also have healthcare shocks. As you grow older, some certain things happen without even being planned for. Perhaps you might get into a minor sleeping accident and you end up injuring yourself, and you need much more intense. You need much more specialized care. So things like that happen during old age. You also have to think about that, because those can now lead you into a financial situation because you had not properly planned for them. And then you also have to think about your costs. Who are you as an investor? Perhaps you're a very disciplined person. So whichever money you have allocated for yourself per month, you're able to spend that and still keep some for a rainy day. Perhaps you're someone who is a bit more impulsive, so you need to put more guardrails within your savings, perhaps limiting the amounts that you can withdraw at a certain time. So you also have to think about that. And also the kind of life that you'd want to live. What are going to be your costs? And we'll look at that and how that plays into the kind of savings that you need to put in and how you need to invest for your retirement. Then we also have the retirement approaches, and we usually categorize them into three broad categories, with investors falling within any of these three. So the first one is a traditional approach. The traditional approach is whereby you're just saving for, you just put it in a low risk savings fund, and you only get you get a minimum payment. You get some payments out per month. It's very simple. You're not taking any risk at all, and you're not being actively involved in your portfolio. You just leave it to your fund manager or whoever is managing your portfolio to manage that for you, and you just get your income to sustain you. So this one offers guaranteed income and simplicity, but sometimes it lacks flexibility rates from this portfolio. You might end up now incurring, if you're getting low returns from this portfolio, you might end up now being eaten in by inflation. So at the end of the day, whatever you're getting is much less than inflation, and then your returns are being depleted. The other one is a flexible approach where you allow yourself to have some stability in the guaranteed part of the investments, but you also keep some money aside, or you allow some investments in a way where you can tap into opportunities. So, for example, if there's an upcoming opportunity to invest, you still have some money that you can put aside and take advantage of that investment. So it's usually a mix of the two, and requires a lot of discipline and risk management so that you don't deplete your entire portfolio. Because you can see on the traditional approach. Sorry?
Sorry, we broke
Hello,
a
can you
little
hear me?
bit. Yeah, we broke a little bit, but I think now we can hear you.
Oh, okay. Sorry for that. So I'll just recap the three approaches I had mentioned. So the initial one I've mentioned is the traditional approach, whereby you're investing in a very low risk investment that is generating you modest returns, very stable. You're such a passive investor. You're not actively involved in the management. You've outsourced this to professionals to do the investment for you. Then on the other side, you have the active approach. So in the active approach is where you're a you're a very astute investor. You're conversant with financial investments. You're conversant with the various tools for investment. You have many opportunities that come your way and you're able to tap into these opportunities and generate your return for yourself actively. And then in the middle, we have the flexible approach. So the flexible approach combines the two approaches whereby you have an amount of your portfolio put in a traditional investment where you're getting your stable return, you're getting your regular income, but also you allow yourself a percentage of your portfolio to tap into opportunities. Any opportunities that come about that are lucrative and make sense and align with your financial goals, you're able to tap into them and get a bit more return for yourself. So there's those three typical processes, and they vary based on the type of investor and how conversant you are with investments and whether you're confident in yourself as an investor and whether you're able to generate, whether you're able to shoulder certain levels of risk. So then the next important part for us to understand is to get to understand the retirement planning cycle, because retirement planning happens in stages. It's not a one-stage process. You have to, first of all, get to understand yourself up until the point where you're able to build a stable portfolio. So we'll start with the first step, whereby it's similar to what Mantui started us off with, is getting to understand what you picture your retirement to be like. So for myself, do I see retirement for me being fully resting, not doing anything at all? Or do I see myself perhaps being a consultant and passing on my knowledge and my expertise onto the next generation? Or do I perhaps see myself as a business person who is going to be still actively involved in the businesses that I run? Or do I just see myself as a relaxed passive investor who will outsource all this work away to professionals who will do that for me? And now when you picture that lifestyle, now you also picture the kind of cost that you will incur. So if you're actively going to be involved in work, are you able to supplement a bit of your income with a bit of your pension with the income that you'll be getting from those active consultations and active engagement? If you want to fully rest, are you able to now survive on whatever you're planning for, and how much is that going to be? So when you set that, you decide, okay, I need to create a 20-year plan because I'm retiring in 20 years, and this is how much I need to save in those 20 years. So you calculate your 1 year spending by saying, okay, this lifestyle that I anticipated, perhaps I said I need to live on 100,000 a month. So that 100,000 a month translates to a lifestyle of around 1.2 million a year. So I need to factor in 1.2 million a year with inflation adjusted, because of course the cost of money is going to change over time. So I need to factor that in, and that is going to give me a figure that I'm now able to estimate how much do I need to save up for retirement. So you compute how much that nest egg is going to cost you, your total savings needed for retirement, having factored in inflation. And then you work backwards and set a saving rate. So you say, perhaps I need to save up, I need to have at least 20 million, or perhaps I need to have 25 million or so, just for illustration. So once I do that, I'm able to now break it down and see, if I have 20 years to save this up, so how much does it mean I need to save per month? And where should I invest that money once I'm saving it? What are the buckets that I'm going to put it into? What are the short term, what are the medium term, and what are the long term buckets that I'm going to put my investments in? And what kind of returns am I going to take, and what kind of risks am I comfortable taking? And then so you choose your investment mix and you invest your portfolio based on those investment mix that you're comfortable with. And then the next thing is also now to put protections in place, whereby you ensure that your investments are secure in that you're not going to deplete the value of your investments, as opposed to whereby you just typically keep all your retirement investments in cash. The value is going to keep getting depleted if it's not earning anything. So now you decide how you're going to protect that by getting a proper return. And also you're protecting yourself from distribution, from improper distribution, whereby you may end up now withdrawing some amounts even before it's time for you to withdraw. So you set those guardrails, perhaps set a maximum amount that you can withdraw from that retirement fund. In our regulations, at least we have some regulations that protect us from investing our full pension amounts. but also in your individual pension, you should also set in your individual pension portfolio. You should also now consider setting those guardrails so that on a rainy day, you're not pressed to tap in from your retirement savings. You're still able to plan for that and keep that aside without touching it until it's time to access it. And then the most important part is also to review your plan yearly because things change. The economy might change, the industry might change, even your income levels might change. So you need to plan accordingly. So every year, take time, even more frequently, take time to review your retirement plan. Is it still working? Are there any adjustments you need to make? And when those adjustments you need to make, are you able to consult with a financial professional who can help you guide you and settle on the best option for you, what works best for you? Then there's various, I touched on this a bit on the previous slide, but there's various ways that you stay engaged during retirement. With the first one being, perhaps you might choose to just do community volunteering where you're not actively involved as a worker in the community, but you're volunteering, giving your time and giving your knowledge. And you're not and perhaps you're not getting any income from that, so you're depending on your savings and your pensions that you've been putting aside. Then there's part-time consulting, whereby if you're an expert in your field, or you're a professional and you're still active enough and you'd like to keep engaging and passing on knowledge to the people that are coming after you, you continue with that while still making some money from it. So it reduces the financial pressure because you're making something complementary that now supplements your pension incomes. Then you can decide to be full rest with minimal savings where you're not doing anything. And typically you'll see that this will happen as you grow older. You'll end up now, even if you started your retirement as a part-time consultant, at some point you'll now need to go into full rest, depending fully on your savings. And you'll find that mostly at this stage, most people who get into this stage, they are depending on a pension, which is now category 4, where it's pension reliant retirement. So you're heavily depending on your pension with little active engagement in terms of work and in terms of income generation. So each of these strategies was going to determine how you're going to save up, because if you're going to be actively involved in the market, you're going to be doing some work, you're going to be doing some assignments, it means that you won't need to save as much or put as much pressure on yourself to save, because you're going to supplement that a bit. It's still very essential and it's still very important that you put in a proper retirement plan, but at least you'll have a buffer that allows you to get some income that can also now even open up more opportunities for you, give you funds that you can now use to invest and expand your portfolio. But if you're fully going to be resting and depending on savings, it means that you intensely have to make sure that you have planned yourself thoroughly and meticulously. And also wherever you're investing, the returns that are going to be there are going to beat inflation and you're going to still maintain the cost of living, that maintain the lifestyle that you had even while you're working, or the lifestyle that you started with when you retired, so that it's not going to deteriorate. And you're also now thinking about the medical expenses and any other unforeseen expenses that might come your way as you proceed with your retirement. Then the next thing we'll look at is the different phases of retirement planning, because you can look at retirement planning as a multi-phased approach, where you start with your working years, the years just before you retire, then your transition just after retirement, and then now the period after retirement onwards up until you pass on. So what we'll look at is we'll categorize them into 4 main stages. So starting with the accumulation stage, this is where majority of us are. When you're doing your business, when you're doing your job, you're earning a salary, you're earning your business income, you're earning any other income, rental income, any other additional income that you have. So at this point, you need to save at least 15 to 20%. It is recommended that you put at least 15 to 20% towards your retirement. Pick low cost funds that are not going to deplete your returns with costs. So you have to be very keen on the cost. Some of them have hidden costs. So you have to look at the total expense ratio. What are the total expenses that you're going to be paying on those funds to ensure that they're not depleting your returns? And then keep raising your contributions yearly. In the same way, you factor in inflation when your salary, some inflation is factored in every year, or you allocate yourself a business income and you try to increase your contributions every year. So you should do the same for your pension portfolio. Ensure that you keep raising your contributions when you can, and when you get any changes in income, you should also now ensure that you also supplement the contributions that you're making to your portfolio. And here, what you're targeting as an output is growing balances, and you already have your written targets that you're setting for yourself every year. Every year, as you do your review of your portfolio, you tell yourself, how much do I want to achieve by the next year? And then that year, as you're reviewing it, see whether you achieve your goal and whether you can push your goal even further so that you can build yourself a comfortable nest egg. Then the next step is the pre-retirement stage, where it's 5 to 1 year before your retirement. So at this point, you should be ensuring that you're now building safety, not just focusing on your long-term portfolio, but now you're building cash reserves, because you understand that at this point, you will be needed to start drawing in from your pension, but sometimes it will not kick in immediately. And you also now need to have a safety net that allows you to now be able to, start to live comfortably without any shocks to your lifestyle. So you build a safety net, ensure that you have at least 24 to 36 months of liquid investments that you can easily tap into should you face these expenses. If you have any debts, this is time to clear them, or reduce them significantly. And then you de-risk yourself gradually. You move your portfolio from risky investments into now more stable investments, because you're not able to shoulder as much risk when you're not liquid, when you're not getting as much income as you were before. And then after transition, the 1 year and 1 year before retirement and 1 year post-retirement, you're setting your withdrawals on your portfolio that you only have certain amounts that you can withdraw per year, so that you limit yourself from withdrawing your entire portfolio within the first year. Then you choose the mix of annuity or drawdown. We look at the two and how each of them affects or suits your lifestyle or the kind of retirement that you're planning to have. And then you now also confirm your beneficiaries, who are going to be your beneficiaries after retirement. After you're gone, are you ensuring that they also taken care of, even as you're not getting an income? Their fees are paid, for example. Any other expenses are paid for them, and you're not straining yourself even post-retirement. So here your income plan goes live now. Your retirement income plan is live. And then now the years after retirement is what you call decumulation. So you're now just living off your retirement nest egg. So here, what you're doing, you're rebalancing. When the market is performing well, you're able to now readjust accordingly. When the market is performing poorly, you're able to readjust accordingly. You apply those guardrails that you set, whereby you set some limits for yourself. You're not investing beyond a certain amount. You're not withdrawing beyond a certain amount, because you have to be very disciplined at this point. And then also annually review your fees and your health. Go for checkups in time to avoid, because some of these things can be avoidable. You might end up postponing health reviews or medical checkups, and you end up now getting into worse health than you should have. So if you're able to catch some of these things early, you're able to manage them at a low cost without even affecting your financial future. And then, so here at this stage, the output that you're looking at is sustainable income with proper risk management and risk control, where you're not putting your portfolio in unnecessary risks, because at this point, you cannot be shouldering any unnecessary risk. So then the next thing we'll look at some of the retirement planning options that we have. So the first one is usually the NSSF. This is the foundational one. So majority of actually everyone who is employed formally is contributing to this. So it's a mandatory base pension. So this one you should only treat it as a floor that you must supplement with employer and or personal plans, because even looking at the amount that you're putting into your NSSF every month, in as much as you're committed to it every month, it's not something that you can comfortably live off if you don't have any other additional plans, especially when you're considering the cost of living right now and the fact that it's only set to increase and increase over time. So this is something that you need to plan for, and you need to actively prepare for, ensure that you supplement that. Then the other one that we have is the employer or the occupational schemes. So if you're employed, your employer basically would have an occupational scheme for the employees within that workplace that also includes something we call the employer match. And the employer match is whereby if I'm contributing 5% or 10% of my income to a pension, my employer is able to match that amount. And this is something that we always recommend, because this is basically free money. Contribute as much as you can to the limit that your employer can match, to ensure that you're getting the maximum out of them in terms of your retirement portfolio. So if you have that available, ensure that you match as you meet the levels that your employer is giving, so that you're able to tap into the full amount on that. And then umbrella schemes, these ones are where multiple employers bring together many SMEs from different companies who it would not make sense for them to individually run their pension schemes because of the administrative costs, because of the amount of work involved. So they group together under an umbrella scheme that now allows these companies to have a scheme for their members and sustain their members without having to incur these high administrative costs because of those economies of scale. Then there's also the individual retirement benefit schemes, where now companies such as the fund managers, they'll offer you pension schemes that you can join directly. And this typically work for people who are self-employed or who are in the informal sector, or who are just trying to supplement perhaps their NSSF or perhaps whatever their employer is giving them. So they're supplementing that. So that's an option for you to also consider. And then there's also the provident and the provident funds and what you call pension funds. So provident funds will typically focus on lump sum payouts, while pension funds will focus on giving you a regular income. So you'll choose you choose the options based on whether you want the cash upfront or you're looking for a steady payout. And you look at some of these options and what they mean for you as you're planning for your retirement. So how do you contribute to your pension? There's 4 main ways in which you can contribute to your pensions. So the first one is through your payroll, where it's deducted from your salary automatically and put into your pension. And this is what majority of workers have, whereby it goes automatically. You're not involved in that contribution. It just happens at the point of payment. And then the other one is what we call AVCs, or additional voluntary contributions. So for example, whereby you say your minimum employee contribution for your pension is 7.5%, but your employer is willing to match up to 15%. So someone might say, I'll just double mine so that I get to the 15% and get my employer match that 15% to get to a 30% monthly contribution to my pension. So the amount above your regular mandatory contribution is what you now consider the additional voluntary contributions. And also now, if you can also now do that by choosing to get into the next step, which is the personal pension or individual retirement benefit schemes with an auto debit, whereby in addition to your NSF perhaps and what your employer is giving you, you also now set your own individual pension. And this one you'll find it also happen with business people. So they put their own individual pension that they're able to save up to, and it's auto debited so that they don't have to keep it doesn't take too much discipline for them to do that. It happens without even them being involved. So the money automatically goes into your pension. And that fixed amount is now put in a pension that yields a return and helps you build your future nest egg. And then there's also diversified low-cost funds, whereby now voluntarily you can now take money and put it in low-fee funds that spread your money across various investments. And this typically happens when you're not very conversant with the investments industry, and you don't want to take the risks of investing by yourself. So you invest in funds that spread out your risk, that they have qualified fund managers who are doing this work of reviewing the portfolios and ensuring that they're investing in the best yielding assets. So I'll stop at that point. We can take a few questions before we proceed. Any comments that are coming in? I request Elizabeth to help me with that. Any comments? I'm seeing a few. Someone is saying the current unpredictable tax deductions are impediment to savings. Yes, as your income is affected because of the tax deductions, it's also now you have to consider now how are you able to now readjust and still maintain your regular expenses while still committing to your retirement plan. So that's a very good challenge to point out. But we can discuss on how some of the options that you can apply to ensure that you're still committing something extra to your retirement plans. Then we're seeing what is your take on falling T-bills as a monthly retirement plan? So on the T-bill returns, I would say that you have to consider that T-bills are typically very short-term investments. And even in your retirement portfolio, in as much as you'd like to take advantage of any returns that perhaps are coming from T-bills, you need to also consider that these are short-term investments, and you need to think of long-term that are going to preserve your capital and are not going to expose you to the point whereby the maturity has arrived and you're tempted to take it in, to take your money, to take the money and perhaps invest it or doing something else without thinking about your retirement. So they should only play a small role in your bigger retirement portfolio. And then just curious about foreigners. We are in Kenya for the duration of our contracts. How does that work? So now this depends on where you want to, what you're thinking about your retirement and your career plan. Perhaps it might make sense now investing in your home country and thinking about putting your savings there. Perhaps it means a blend of the two, whereby you're still taking advantage in the emerging economies that are able to give you higher returns than what more developed economies would give you. So you might be put some here as you're thinking about growing that, and you can even transfer as time goes by. So it's all based on your individual preference and your individual goals and your career alignments. So we recommend that you all look at it in an individual sense. So I'll pause on the questions for now. I'll continue on the next slide. Feel free to continue bringing in the questions. Elizabeth will help me tackle the questions as we go along. So the next part that
Maybe Brian,
you're going
maybe
to
just one
look
quick
at.
one. If we can be
Okay.
able, sorry,
Sure.
Brian, if we can just be able to get the questions like Manju is saying on the questions tab, it will be easier for me to respond as women continue. Let's do the questions on the
Oh,
question and
sure.
A tab as opposed to the
Sure.
chat, because it's difficult to respond on the chat.
Okay, great.
Thank
So please, let's kindly put our questions in the Q&A tab so that we enable easier handling of those questions. We'll be able to handle all of your questions, so kindly feel free to do that. So we'll continue with now looking at retirement schemes and comparisons of various retirement schemes in terms of the kind of structure that they take. So we get to understand, I'm sure most of us understand what a retirement scheme is, but we'll just reiterate just to refresh our minds. So a retirement scheme is a regulated pool. So regulated in that it is licensed by the RBA and it is overseen by the RBA, so that your interests as a retiree are protected. So it is a regulated pool that collects member contributions, invests them, and pays benefits at retirement or at qualifying events at various stages. The qualifying events you basically refer to stages. So why should you join a scheme? You join a scheme first to build long-term savings in a disciplined and tax-efficient way, because you also have to remember that tax has a huge impact on your returns. So you need to build long-term savings in a disciplined and tax-efficient way with governance custody to protect your money. So you're ensuring that your funds, wherever they invested, there's proper governance, they're overseen by professionals, they have leadership that is qualified to overlook and to also now properly report to and work in tandem with the regulator to ensure that your returns are protected. So we've looked at some of the scheme types in the previous slide, but I'll just touch on them now in a bit more detail. Starting with NSSF, we mentioned that NSSF is the basic mandatory floor level, and it should only be your bare minimum. It should not be the only one that you have. It should be your starting point and ensure that you complement it. So it suits all workers, and it's a basic government pension, as you've mentioned. So you get small fixed deductions from you and also your employer by law. These are mandatory and they have to be done. And then at retirement, a small monthly pension is paid out if you meet the contribution rules, or you can either get a lump sum payment. And then the pros of this is it's a very simple and government regulated base pension that you can rely on, but you should use it as your foundation and not as your full plan. Because as you've seen, you are not able to depend on it fully, considering the kind of lifestyle that we have all envisioned for our retirements. You can't be able to sustain that comfortably if you're living on NSSF contributions. Otherwise, you'll end up getting into debt and into unnecessary financial situations during your retirement. Then what to watch out for, ensure that you top it up with other savings. Then we've talked about your employer contribution scheme, where you have employees who are being matched their contribution by, who are being given who are making a contribution that is now being matched by their employer. So money is deducted automatically from their salary, and your employer matches that amount and contributes it to your pool of funds. And then this match is what we said, you consider it free money, and by tapping into it, you're able to make saving effortless, because you're getting a huge chunk of your money going automatically without even having to be tasked about it. And this money is being invested by professionals who have expertise in the industry. But also now you have to make sure that be keen on the provider, ensure that you're keeping an eye on the total expense ratio so that you're not depleting your savings and your returns in costs and other unnecessary charges. Then we've also talked about the umbrella scheme, where it's MSMEs and groups that want a ready-made pension platform. So employer and employee contributions are paid through a single umbrella provider. So all these contributions are pulled together and they tap into the economies of scale to avoid issues with to avoid issues with unnecessary administrative cost or too high labor cost when doing the administration work. So that allows all these employers to provide their members or their employees with a scheme for them. So you gain scale and lighter admin work and the stronger governance than going alone, because you have experts from different fields all coming together and supporting this, most of them being experts within the pension industry and within the financial services industry. So here you're comparing provider quality, you're comparing fees, and also the kind of reporting that they do. Is there regular reporting? Are you able to see how your funds are performing over time? Are you getting statements on your portfolio and how it's growing? What is making it grow? What are the challenges that they're facing in investing your portfolio? You also need to really check that. Then there's the IRBS, or the personal pension. Now, this is what typically you do if you're a business person and you're supplementing or you're an employee and you're supplementing your NSSF contribution and your employer pension contribution. So this is where you put your money there, and then you make payments by monthly debit or flexible deposits when you can. So this one takes a lot of discipline. You need to commit that amount every time and ensure that you're remitting the amount. Optionally, you can take it away from you by putting a standing order whereby it goes automatically without you thinking about it and helps you stay on track and be disciplined. So it's very flexible and it's portable across jobs, because even as you switch jobs or you move business ventures, you're still able to continue making those contributions without huge changes in when you're transferring. But now it needs discipline, and the fees differ a lot between the different providers. So even as you're checking this, you also need to consider the provider quality, the fees, and also the kind of reporting that they do. Then we also have the Provident Fund. And the Provident Fund is for people who prefer a lump sum at retirement. So you make the regular contributions, and typically for them, they give you a lump sum when you get your retirement age. And it gives you cash upfront for projects or for clearing debts, or now you can invest into an annuity or a drawdown instrument. And you're going to look at this and what each of these means and how they affect your portfolio. And then with this, you remember that you need still to keep a separate income plan for monthly bills after the lump sum, because once you get the lump sum, you still need to incur your daily expenses, and you want to do that in the best way possible. And so we'll see some of the options that are available for you to ensure that you're taking full advantage of that. So we look at some of the options that we have in terms of retirement income products. So we look at how you're converting now your retirement savings into income that you're generating throughout the life of your retirement. So a retirement income product is any tool that converts your accumulated savings, so be it in NSSF from your employer, or you had put in your umbrella or personal pension, or any other investments that perhaps would pay you a lump sum at that point. So you need to put them into a steady paycheck that you can live on in retirement. This helps a lot with the discipline, and also helps with the factor of time value of money, because if you keep your lump sum, it might keep deteriorating over time. Over time, you want to keep your money in somewhere where it's generating you a stable return, a return that you can now and a payout that you can comfortably live on. So this is how you do it. The first option is doing guarantees, where you invest in a guaranteed income, fund, where you're getting annuities, and you get the regular payouts that ensure you have that financial security. You're not worried about that lump sum payment. Then you also have the option to stay invested, whereby if you had investments that you had put in various places, you continue keeping them there. But now for this, it needs a lot of discipline and a lot of financial savviness, because you're taking a lot of risks, because by making an investment, that investment might not perform, or might even completely deteriorate. So you need to really think about that. Are you willing to shoulder those risks? And are you comfortable enough to shoulder those risks even longer into your retirement? And then now we have the hybrid approach, which we mostly recommend. So whereby you have a blend of a guaranteed fund that is giving you something stable and consistent, but you're still allowing yourself to have some investments that are able to allow you to tap into other opportunities that are potential to generate you higher return. So we recommend a blend of the hybrid approach. Works best for most investors. But now, if you want to use the hybrid approach, you also have to remember that you need to keep yourself very aware of the risks and any of the investment challenges that you might incur when you're putting some money in active investments. So we've talked about annuities as a retirement product. So what is an annuity? So an annuity is basically where you're buying an insurance contract that you exchange your lump sum. So let's say, for example, your pension has come as a lump sum. So they buy that lump sum from you and they pay you a guaranteed stream of income for life or for a certain set period. So here you're able to now delegate that work of investing and ensuring that you have a stable income to a licensed insurance company who has proper actuaries and fund managers who are able to properly assess the market and ensure that they're investing in the best manner, and then they distribute your payments to you. So how it works is you pay insurer a lump sum and then they pay you a fixed or an inflation-linked income. So it can be a fixed amount or they can be adjusting it for inflation so that it ensures you still maintain your standard of living over the rest of your life. Then the other option that you have is the income drawdown, whereby you keep your money invested and you draw a planned amount every year. So the income can vary based on the market performance and your withdrawal rules. So perhaps you say, I'm going to keep my entire portfolio invested somewhere, and then it's getting a certain percentage. Let's say it's getting a 4% or a 5% amount it's getting a return on that, or a 10% return on that. And then I commit to a certain percentage that I'm withdrawing every year. And now this percentage is not going to be based on how long you anticipate to withdraw it from, basically how long you expect to live on this pension for. So it's going to be very personalized based on your own financial situation. But you also now have to remember that you need to keep guardrails and a cash runway for yourself. Basically, we mean that you limit yourself in withdrawals, that you're not going to be tempted to withdraw your entire portfolio. And also you have some cash stable, so that you're not selling your assets when they are undervalued or when the market is low just because you didn't have any cash reserves. So this one requires a bit of financial expertise and financial acuity so that you're able to properly safeguard yourself. Then we'll look at the hybrid retirement income strategy. So here is where you have a blend of the guaranteed income. Either it can be you bought an annuity, or you have your regular and safe payouts, or your pension payouts from your pension provider, but also you have some in an investment drawdown for that allows you to get some income that you're able to now utilize either for reinvestment, or you can now use to sustain your lifestyle even post-retirement. So what are the things that we need to look at when I have these options? They have the options of choosing an income drawdown, I have the options of choosing an annuity, I have the options of, there's so many options for me to even think about my retirement, pre-retirement and even post-retirement. But now we need to start thinking about, how do I know who is the right person to go to to manage my retirement or to help me plan my retirement? So the first thing that you need to look at is their financial strength. You need to invest when you're putting your retirement, or when you're looking for a retirement service provider, you need to consider someone who has a strong balance sheet and they have clean audits. They have proper fiscal management practices. They have a track record of showing that they are properly managing money, and they have a stable balance sheet so that they are not going to incur challenges when people are withdrawing their money or they're facing any liquidity challenges. Then you also need to look at the investment process. Are they diversifying the investments? Because if they're not diversifying, it means they are losing some opportunities in the market. So ensure that they're diversified, but even in the diversification, there's proper risk control so that they're not exposing your entire portfolio, your entire retirement portfolio, to risks, because this is your future and your children's future. So you need to properly guard it and ensure that whoever you are entrusting this with is properly guarding it as well. Then you also now need to think of the total expense ratio. So look at the fees and the transparency that they have around those fees. Ensure that there are no hidden fees, hidden charges that you're not able to plan for. So ensure that these are very clear, and you see the total return that you're getting net of those fees, and it still makes sense to you. And then, how accessible are they to you, and what are the kind of access points that you have to them? Are you able to visit them at the office? Are you able to call them? Are they able to answer any questions that you might have? Are they able to support you in planning your retirement properly? So this is a true value add that you will need even post-retirement, because after you retire, perhaps you want to retire up country. You want someone to be able to withdraw, to make your remittances without them making the process complex for you. You have to keep traveling, you have to keep following up with them. So you have to ensure that that is available for you. They're able to give you the proper advice and able to guide you accordingly. Then also look at the kind of options that they have. What kind of products they have? Do the products speak to you? perhaps for you, maybe you're living with a chronic illness, so you'd need someone who has proper medical cover or has proper medical arrangements in place or financial cover for medical emergencies in place. So you need to think about that and you need to plan for that even as you make your retirement plan. Look at also the portability options. Are you able to move from one product to the other should your financial situation change or should your financial goals change? So think about that and how accessible that is for you, and that will speak a lot to the kind of provider that you'll get. Then also consider the claims and payouts. As I've said, you don't want someone who's going to be delaying you, and you have standing orders perhaps that you've said, then they delay, then you end up having to borrow to pay, things like that. So ensure that they are going to make their payouts on time and they do not default on claims. So make sure that you thoroughly research into them and their track record before you settle on a service provider. So this is just an expounding on what we've mentioned, some of the features that you need to consider when you're looking at your service provider. So we've mentioned look at the total fees or the total expense ratio, ensure that it is low and it's transparent and an all-in total expense ratio. There's no other hidden charges that come in after the period that you're not conversant with. And then also look at the investment options. What are the kind of range of funds that they have and the stability of the funds? Are there age-based plans or goal-based plans? And are they able to guide you and walk you down the right path? Then what guarantees or options are there? Do I have capital preservation where I know at least my capital is going to be preserved and only the rate of return might fluctuate? Just ensure that you are aware of all those options. Ensure that you have a mix of proper annuity choices and draw down rules. And you get to understand what those mean for you and how they work within the lifestyle that you plan for your retirement and that you're envisioning for your retirement. Then also consider the liquidity and access. Are you able to easily access them when you need? So for example, if you need to tap into some funds for when you're growing emergency, or you need to tap into these funds when your kids perhaps are going to university or they're going to another stage of their lives and you need to fund them. So are you able to access those funds? So ensure that that is properly catered for. And then you also need to look at the beneficiary terms. What is the terms when you pass on? Are you able to, your beneficiary is able to get paid consistently without a lot of hassle? Is it going to be planned? Is it going to be seamless for them? Do they already know how much you have saved up so that they are not, it's not hidden in funds that you'll never be able to access or they'll never be able to know of? So ensure that there's that clear transparency. And then also reporting and tools. What tools are there available for you to get your statements? Are you able to access it through your mobile phone? So that even when you're in the village, you're able to see your statements, you're able to see how your funds are performing, and they're easily accessible on call. And also the service and turnaround time, because you want clear SLAs, consistent service, and because this is someone who you're trusting with your future after you're at a very vulnerable stage when you're not going to be able to provide for yourself. So this has to be someone that you fully trust and someone that is going to deliver to the service that they promised. Then I'll talk a bit about building a robust retirement plan and in terms of buckets. So there's three main buckets that we typically consider when you're investing in when you're putting down our retirement. There's a safety bucket, there's the income bucket, and there's the growth bucket. So the safety bucket is what is just allowing you to pay bills during bad markets and peace of mind. So they're very liquid and you can easily tap into them. And then you have the income buckets, which are now for giving you stability and interest income. Sorry, just to mention, in the safety buckets, this is where you'll see people putting money market funds, T-bills. There'll be a bit of cash, but you prefer to put it in cash equivalents, whereby you're not just putting cash that's not generating something. At least you're putting it, at least at the very least, in a fixed deposit or in a money market fund that's able to give you a bit of a return that's above inflation. And then at the income bucket, you're looking for high quality bonds and funds that are giving you a high yield. They're giving you stability and interest income. So you have that capital preservation and you're able to earn interest income on top. And then now for the growth bucket, now you're looking at diversified equities and other tools that are now able to give you higher returns. You're looking to beat inflation and grow your future income. And so the order is you have to start with safety, then you build income, and then you build growth in those stages. And then there's different mixes based on who you are as an investor. You have the cautious mix where you're just putting in 20% in safety, 35% in income, and 45% in growth. These are just suggestive, but they work. Your unique Your unique mix will work based on your financial future or what you're planning, your financial goals and your financial situation. So you have the cautious mix where you're putting 20% in safety, 35% in income, and 45% in growth. You have the balanced mix where you're putting some in, say, a smaller amount in safety, the 15%, 35% in income, and 50% in growth. And then you have the growth mix where you're putting 10% in safety, 30% in income, and up to 60% in growth because you're targeting growth. So when you have more in safety and income, you're more calmer because at least your capital is preserved. But when you have more in growth, you'll have bigger ups and downs, but you're able to get huge returns on you're able to get huge returns on your when your portfolio is going to yield a higher return. So we've mentioned about having guardrails when it comes to saving and investing. So these are basically rules that you set for yourself when it comes to withdrawing your retirement fund from your retirement fund. And we're going to look at how do you move from unsafe withdrawal strategy where you have a high risk of portfolio depletion because you can access your funds very easily. And it's very tempting. Sometimes it's genuinely you got caught up in a bad financial situation and you need to get yourself out. So you end up tapping into your retirement funds, which are supposed to be for long-term savings, not for short-term obligations or to get yourself out of a short-term situation. So you start by setting an initial withdrawal rate. So you start at a very low rate and adjust for inflation. So it's recommended to at between 3.5 and 4.5%. That's where you should be ranging within when it comes to your withdrawal, and that's post-retirement. Before retirement, try as much as possible not to be able to access those funds because at this point where you have income, you should not be tapping into the funds that you're depending on for a point where you will not have any income. Then always track your performance and make adjustments as needed. So there's times your portfolio will be performing very well. So that means you need to commit more into your retirement and even reinvest. But then when the markets are performing not too well, it means that you don't need to be liquidating your assets. So you live on your cash and cash equivalents. And then you also need to replenish funds in the good years I've mentioned. When your portfolio is performing well, ensure that you replenish and even as you're saving up for your retirement, or the months you get a bonus or you get a good return, you tap more of that into your retirement because you're building a future for yourself. And by putting these guardrails, you're able to now get into a safe withdrawal strategy and you are at a low risk of portfolio depletion. So how do we build a secure retirement? So the first thing, we need to consider three things. The first thing is properly managing your debt. And that is why we were suggesting, even before you get to the point of retirement, ensure that you've cleared as much debt as possible. So you reduce high interest debt and you manage housing costs effectively. So if you're paying for a mortgage, try pay off as much of that before you get to your retirement point so that you're not committing a huge part of your income, of your retirement income into paying debts. Then ensure that you get adequate medical cover because you said as you grow old, some of these medical challenges will come about and they're guaranteed to come about. So you need to plan for yourself effectively so that you don't deplete your retirement portfolio by using that to pay medical expenses. And then maintain an emergency fund, a separate emergency fund for unexpected expenses so that you're not having to liquidate your assets when they're at a low value to be able to pay for these expenses. Then one of the most important things that we need to consider also when you're planning for a retirement is looking at our retirement health. And we need to ensure that we are healthy enough even as we go into our retirement stage, that we live long and we avoid unnecessary medical expenses because of avoidable diseases. So we always recommend 6 things. The first thing being sleep. Ensure that you get proper rest because it is very important for your development and for your health. So ensure that you sleeps that you get sufficient sleep and ensure that you are committing time to that. Avoid devices before bedtime. Avoid stressing yourself before bedtime. Take time to get proper sleep. And then movement. Stay active because physical activity boosts health and financial stability because you're now even more active and able to be more mentally acute. So you're able to work hard and provide for yourself better. And then always do your annual checkup so that you catch some of these things early so that you're not dealing with it when it's too late and too expensive for you. Then also community support. Build a community around you that supports you. Build social structures around you that support you because this will enhance not only your mental health but also your physical health. Proper nutrition, that goes without saying, eat right and take care of yourself. And also preventative care. Some of these things you can avoid by eating healthy, by going for medical checkups, by ensuring that you have that you always that you always consistently listen to your body and ensure that you see your doctor whenever anything is happening, so that you get proper medical attention. Then when it comes to managing retirement health expenses, so what do we need to consider? So the first thing that you need is to create a health budget, so you know how much is going into your health management cost per month, even in your retirement. Organize your insurance information, because sometimes you might have all these plans laid out, but your people who are taking care of you don't have the access to this information. So perhaps you have a policy, but you're not able to tap into it when, for example, something happens and you're not conscious and you're being taken care of. So people have to start scrambling to find your insurance information. So ensure that it's easily accessible, and then maintain a medical reserve. So have some funds aside that protect you should you face unforeseen health related expenses. You can tap into that without having now to liquidate your retirement portfolio, which you're supposed to live on to pay for your health expenses. So we've said proactive healthcare planning. So start by estimating future needs, project some big ticket items and chronic care, even start planning for funeral care and things like that. You have to start thinking of those even now, so that you're not overburdening your dependents when you're gone. And then also now review coverage, assess dependent coverage and assign budgets to that for your dependents, ensuring that they're properly covered. Then another option that you have for your healthcare planning is what you call post-retirement medical funds. And post-retirement medical funds is basically a separate pot for healthcare, separate from your typical retirement. It is where you're saving up for healthcare costs. And this is something that you should ensure that you review yearly and consistently readjust and ensure that you invest in it, so that you're not met by unnecessary medical expenses that deplete your retirement portfolio. So I'll conclude with this slide, where we are looking at the various steps that we need to follow to get to a secure retirement. We've seen the annuity versus drawdown option, whereby you have different options that allow you to either get the guaranteed funds, or you're able to now tap into the returns, but you can now use a blend of both. We've recommended the hybrid method, because it allows you to tap into both while still staying safe. And then you set a withdrawal
Brian,
rate for yourself. Yes,
so
sorry.
sorry for the interruption. I was thinking maybe we could take a short break and then you conclude with the last two, then we have questions and answers.
All right, sure.
Okay, good. Right, let's proceed on a 10 minutes break, so that we can come back fresh for the final slides. Thank you. We shall resume with the remaining part of the training. And maybe we can have, before Brian comes in, any reflections. I see Shemina, your hand is up, and as well. And just before Brian comes back in, you can speak. I don't know if it's questions or any comments you might have. Shemina, Anne. All right, I think maybe we can try again later. Karibu, Brian, we can continue. Oh,
I shall continue from where Brand left.
okay.
So I think we have had a time to reflect in terms of the various options that are available, that is from the capital market. And this second part will be largely looking at the questions and answers. But before we get to that, I would like us to, for some of us here are running organizations. So since some of us, let me just put I thought my screen was on. It helps with credibility. So one of the things that I would like us to just think about is some of us are running institutions, maybe in the MSME sector. What are the things that you can do to manage savings for you and your employees? And what are the options that are there? So as we speak right now, you are allowed to know all the money that Tier 1 and the Tier 2 of the NSSF. You actually send that to NSSF. But the Act provide that you can actually be able to opt out part of the Tier 2 and take it to a registered pension scheme. So that's what I want to talk about right now. I can't move. And what does opting out really mean? It means that there is the second portion of the NSSF. Whatever you send to NSSF, you can actually select a pension scheme that you are able to. You select the pension scheme and then be sending that money there. So opting out is basically being able to have more control about where their money is invested as opposed to all of it going to NSSF. So that is what opting out is. Why then can we consider opting out from NSSF? One of them is enhanced control, because you and the fund manager, you can actually be able to ask the fund manager the question in terms of where they're investing, and you have more say there. Then number two, you have a little bit of more financial flexibility when it comes to that, and especially if your contributions are higher than what NSSF has provided for. In terms of contribution, that is, you're contributing more than 6%, so that helps in financial flexibility for you. Then it is more cost efficient, especially if you remember what Brian was talking about, as being able to send money into an umbrella scheme. So you're not necessarily setting up your own scheme, but you're joining a scheme that is already established. And then it helps with staff retention because the returns are expected to be slightly more higher. And then there's more transparency when it comes to those investments. And then you create strategic partnerships where you can even get employee conversations on matters money from the service providers that you look at. So if you are running an MSME, it's one of the things that you can consider. If you have anything above three employees, you can be able to join a specific pension scheme. So some of the key things that you need to think about even before you start opting out, one of them is your the administrative responsibility, because now you'll have to be not only dealing with the tier one that you'll be sending. That right now you send everything to NSSF, but you'll have an additional person to speak to in the form of the new scheme that you're opting out to. Then the initial requirements for setup, especially if you have decided to set up your own. It could be, you'll need various service providers. You need to decide who is going to be the fund manager, who's going to be your administrator, who's going to be your custodian. So it comes up with some little bit of initial setup costs and also setup logistics. Then who is going to sit on that board? Remember, you have to have a board of trustees that is going to stand and create oversight. If you're doing it in-house, then those are some of you have to nominate some of the staff members, so you're actually adding them additional responsibility. Then how do you communicate this to the client, to the employees who are the owners of the money that you're actually looking at? And then remember, you have to, before you actually decide to opt out, you'll definitely have to deal with the regulator, who is the Retirement Benefits Authority. So in terms of the process of opting out, and it's just good for us to just know so that as we go and discuss, it's something that we could visualize how this is going to be. One is you need to make sure that you are eligible, and for sure you're eligible. The Act provides that you can actually be able to opt out. Then select the scheme that you want. There are various providers. Some of them are issued by fund managers, the umbrella schemes, and I'm just talking about the umbrella scheme in this case. The fund managers do pension scheme that is umbrella. And also, if you want to do it as an individual, they also have what is called an independent pension scheme. Then you have to make sure that you have all the documentation that are required, and this would include just the normal setup documentation that will require even when you're opening a bank account. And in addition to that, they will give you a form that you sign in, which is called a deed of adherence, just to say that yes, I have accepted to be part of this scheme. Then the application is submitted to the Retirement Benefits Authority. Usually they approve, and then once you get your approval, then you can start spending that money. So the approval process is between RBA and then NSSF for you to be able to do that. So these are some of the things that are already available in the market. And if you're running a pension scheme, it will be important for you to think about that. So, and the umbrella scheme is basically you're just giving this money to someone else to manage on your behalf, and then they send reports to you. So the other key thing about investing using pension scheme is the other thing I wanted to talk about is about the tax advantage. Every single shilling up to 30,000 that you send to a pension scheme, it's tax free. So you calculate the tax relief you get from saving through a pension scheme. For someone who saves a maximum of 30,000, you actually are saving tax of about 5,000. So you can imagine 5,000 times 12, that is about 60,000 in a year. So it's always good for us to think about increasing our contributions all the way to about the maximum amount. It helps us in terms of saving for tax, and that money can actually be used for compounding. So, and if you do that, again, what are the key benefits? One of them, the journey that you have talked with the brand took us through, is actually shortened, significantly shortened. So you are able to make the effort that you require as you retire larger. Then for MSMEs, then you have more staff loyalty, especially if you're able to give them this pension, and when someone else is not maybe enhancing the pension, it helps with the staff loyalty. I think for most of the corporates, and especially people in the public sector, you'll realize that they consider the pension as a significant part of of what you're paying them. So it helps with staff loyalty if you do that, and then you definitely are more competitive to the people around you. So in conclusion, remember that we have talked about what is retirement. Remember, it's not age 60. It is a whole process. From the time you get employed, you need to start thinking about how will the world look like when you're less energetic. So you have to build around it. So when should you start thinking about your retirement? I think it's the first time that you start earning your money. Because remember, if you want to retire in a beach, what are you doing about it today? So from today, what is it that we are asking you to do? Please, let's let's document a plan where we want to be in maybe 30 years from today, and then ask ourselves what is that we need to do. One of the things that you'll realize that when it comes to investments, let us automate, because anytime you don't automate, you have to think about what you need to do with that money, or think about that you need to send that money somewhere. In most cases, you'll not do it. So automate so that the money does not come to your account, because you'll definitely get something to do. Let's get the right service providers. And remember, there are very many, over 20 service providers in the individual pension scheme or the umbrella pension scheme. So you need to select the right one. Do I want a guaranteed fund, or do I want one that is segregated, that invests in the stock market? Then make sure that you look at your strategy on an ongoing basis, and you don't have to get stuck. If, for example, you're in a certain pension scheme and you realize that that's not what you want to do, you can actually be able to move that money. If you're employed, you're also allowed, and you change employers, you're allowed to either leave the money in the scheme that you are in, or you move it to an independent pension plan, or even to your new employer. So that all those things are available for you. And then one of the other things that is really, really a big problem is updating of beneficiaries. Most of us forget to do our nomination. So you are employed the first time, but we don't remember that when our life circumstances change, we do not remember to change the people that are around there. So in summary, remember, it's today. I'm thinking about how I'm going to live in retirement, but the biggest problem is how do I walk that journey towards retirement? So Mansuri, I want to post there, and maybe we can take questions.
Thank you. Thank
I
you
want
so
to stop
much.
there.
Thank you. Thank you so much, Elizabeth and Brian, for a great session on planning for retirement, and for just also taking a comprehensive approach. I've seen that was also brought out by participants, that even the health angle, beneficiaries, and just thinking it through from end to end, where we are at now and where we want to be, so that we don't have a situation where we are panicking when it comes to retirement, but it's a plan that has started quite early and in a structured manner. So thank you so much for that great training. I think I can start with a question from Paul, who says, what is the difference between the NSSF and umbrella scheme? And I'll also encourage participants to share their questions on the Q&A tab. And if you do want to ask the question yourself, you can raise your hand and we'll enable you to talk. Thank you.
So the key question, the difference between NSSF and an umbrella fund, actually, I would say NSSF is one big umbrella fund. However, it is largely governed by the government. This is a mandatory contribution scheme that you send to. So, and there's still some money that needs to go there, even if you've decided to go to a separate scheme. So the first, there's a way they calculate it is based on the minimum wage. 6% of that has to go to NSSF, that is called Tier 1. And then Tier 2 has to go to, you can take the Tier 2 to another scheme, but you don't have to. So the difference is that one is run by trustees who are largely appointed by the state, whereas an umbrella scheme is led by the private sector. So people in the pension industry will set up a fund similar to what a money market fund would be, and the umbrella, they would go get different employers to actually subscribe to it. So you'd have one pension, one umbrella scheme having as many as 100 or more pension schemes to get there.
Thank you. Thank you, Elizabeth. Then there's one question that touches on the trainings we've had, especially session 2 on investments and today's. This is from an anonymous attendee who says, I'd like to plan for my retirement using stocks and bonds. Please take us step by step on what to do after opening my those CSD account. My account has been approved, but I don't know what's next. So I think this ties in very well with the previous sessions and today's session as well.
So what happens is once you open your CSD account, you now look at the bonds that are there on offer. So like on treasury bill. So every week there is a treasury bill on offer. Once a month there are bonds on offer. So what happens is once you go to the CSD account, you'll actually be able to see what you can buy. So you need to go there, say this is what I want to buy. You make a subscription. But remember, they will just want to get a commitment from your bank that they are going to debit their account directly. So some banks, I think you have with your relationship manager, they will be able to set up the payment details for you so that it can just go straight. So on the day that you're successful, your account is debited and your DAO is actually credited with that amount. So it's very straightforward. Just go to the account, you'll see the on offer bonds and bills.
Thank you. Thank you.
So how does T-bills work?
Sorry.
I think there's another question on how T-bills work. The T-bills, you're basically lending to the government, and if they're issued at a discount. So if, for example, it's a 1-year bond that is issued at 10%, what you pay, and you want to buy 100,000, you will pay 90,000, and then on maturity, the money will just be credited to your bank account as well.
Great. And then I think the stocks, mentioned on the stocks as well.
So for the stock, remember these are different accounts. So you won't use the Dell CSD to buy stocks. The stock you have to buy using a CDS account. How do you open a account? You go to a broker. Some of these things are now online. I think I've just seen VD Trader. Now you can actually be able to go to M-Pesa and be able to on the M-Pesa app and be able to start that process. So it's something that you can be able to do on the go. But it's a different account. Alternatively, just visit a broker, speak to a broker. Who are some of the stock brokers? There are things that people like Faida, Dan Blair, Kestrel, SIB, Kingdom, Susan. So what happens to the pension in case one opts to voluntary early retirement in terms of accessing it? Now it's easy to actually access your pension scheme on early retirement. So these are some of the things that you need to read as you get into a pension scheme. What is the early retirement age? I think the early retirement age is about 50 years. So you can access it. For the bonds, no, you don't need to liaise with your bank part. Just go to your bond to your DAO CSD for you to be able to select the bond that you want, assuming you want to buy directly. And then but remember your bank is on the know, or it's part of what you're doing because the money will be debited directly. So the two speak.
I think there's a question on chat by Langat. What's about people employed on contract terms who contribute to the NHIF scheme? Are they eligible to claim their savings once the contract period ends?
No, the money that goes to NSSF is on retirement. So it's I think the retirement should be 60 years. So even if you're on contract. But if you're on contract and your money goes to a gratuity fund, then that one you can be able to access. But however, the problem with gratuity, if you access to your gratuity, the challenge is the tax rates are very high. So when you're on gratuity, what you put money into a pension scheme and you get the tax benefit. I'm trying to look if there are any questions on the chat as well.
Okay.
Currently, the government is offering. So there's either asking whether the 8 and 20-year bonds that the government is offering are good for retirement plan. The answer is it depends. What are the other things that you're looking at? Is this a part of the cash flow? So remember, the answer is bonds are good for your retirement planning, but you need to look at it in the terms of a holistic approach so that we know what is it that we are investing for. If, for example, it's liquidity and you buy into a 20-year bond, the answer is might not be necessarily a great thing if you will need that money for survival and if the coupon is not sufficient for you to do that. So it depends, but in terms of options, yes, it's a good investment option. But for your particular portfolio, the answer would be we need to look at it. Okay. So someone is asking, can we have a part of YNSSF savings to invest in different schemes? The answer is no, you cannot. Once you invest in the pension scheme until you retire, that's when you can access that money. And then on retirement, it's always better to buy an annuity. It helps you with getting cash flow over the period of time. So what would you recommend as the best retirement plan for someone to start saving? I think if you can actually start with an independent pension scheme, if you're not a part of an employer that provides a pension. If your employer provides a pension, please, you can actually do what is additional voluntary contribution so that you are increasing the amount of money that is available for your fund. So the question, what's your take if my retirement have placed in special funds? Yes, some of the special funds provide good returns, so it is just good to understand what particular portion of your funds the trustees have put in and just to understand what is it that they are looking at. If you lose your source of income, Albert, you still can't access this pension scheme. So part of the pension money is to help you when you're old. So even if you lose your money, we believe that you can still get another job. So that money is not easily accessible. Only when you change jobs, actually, there's a portion of that money that you can access. If you lose your job, you can get almost 50% of the money that you have saved into the pension scheme. So accessible, but not 100%. So I think I've answered on government bonds and T-bills. Which is this cost to know this kind of information and then manage people. So, Karen, you're asking which cost to know this kind of information and even manage people investment. What career is it's investment? There's a career called investment. I don't understand Steven's question. The question is there a way somebody can save money and he deny total freedom to withdraw it for specific time frame within? Yes, most of the fund managers actually have that. They guard you, they guard you against yourself, whereby they help you not to withdraw because you might be withdrawing when you don't need it. So I think there's someone on court. I think so how
Elizabeth,
about
sorry,
if you are about to retire and you have
oh, sorry, we had lost you a bit there. Yeah.
So I'm just looking at the charts to see if there are any questions. John is asking, how about if you are about to retire and you have a huge amount of uncompleted loan and the only part is retirement benefits? It might make sense to offset that if you have that money because there is nothing as bad as not being able to, when you have fixed expenses and you have retired. So it might make sense as part of retirement planning to just pay off the loan with part of that amount of money. Then when government still and said, is there a way to people can get it back? I don't think they can be able to. Reason being, the money is well regulated, so it may not be very easy for anyone to take NSSF money. And again, remember they send the money to they send the reports to the RBA on a quarterly basis. And also in terms of the people who manage this fund, They are the fund managers. So these days they don't manage the money internally. So I think what career? So what career can you take? There are different career paths. You can be in investments through your degree in investments, actuarials, maths, and all that. But in terms of the courses, there is some that are offered by CASNEP. I think there is CIFA. There is also what is called CFA, that is a global accreditation that one can take. If you want a crash program, there is what is called CP. So in certified in investment securities, something. What account does one need to buy bonds? That is a DAO CSD. You can just download it online. Yeah. I think when you sorry, there's a last question there in terms of 50,000 long-term, short-term. I would say the bulk of it should go for long-term investment, and you can choose different investment options. So you can do some bonds, and I think in terms of retirement, you could do maximum 30,000 into the retirement fund, so you can get the 5,000 tax benefit.
I think Florence is asking what is an annuity?
So sorry, an annuity is, you see, what happens is you can have a lump sum amount of money. Then what happens is when you give it to an insurance company, then the insurance company will be paying you on a monthly basis a certain amount. So for example, you have 1 million, you go to Jubilee Insurance will take that money, and on a monthly basis, they tell you they'll be giving you 10,000 on an ongoing basis based on the risk profiling that they have for you. So that is what an annuity is. You give money to an insurance company, and then the insurance company will give you a monthly or a quarterly payment. Why is this important? Is because most of the time we are employed, and what we have been receiving is a monthly salary. So you actually just try to replicate that. The law provides that once you have saved, you need to buy a third. You'll get a third of your money, but the other third will actually be used to buy you an annuity, because we believe that it's good to have money that is coming on an ongoing basis, and also the return that you're going to get from there. How and where to buy bonds? So bonds are issued by the government. So what you do is what is called, you go to Google Store, and then you open you download a DAO CSD. Let me just type it there. That's what you look on Google Store, and then from there you can actually fill in everything that is required, your tax documentation. Then once you have that application ready and approved, you can actually start seeing and investing. For corporate bonds, those ones, they are issued by various. You can trade them with the broker, so they are under CSD, similar to the stocks. Can you join multiple pension schemes with multiple providers? The answer is yes. Nothing stops you from doing that, and it will be okay for you to do that. So I am putting my contact details there. You can chat me, and then I will be able to direct you where you, in terms of what you would like more understanding on. We could be able to help you or guide you in terms of setup. If you're running an institution, that is also a good conversation that you need to have when it comes to discussing matters of setup of pension schemes for your staff.
You can see Frida's hand is up.
Okay.
Frida, you had a question? But now it's loads. I don't know. Yes, Frida.
Yes, my question has already been answered. Thank you.
All right, thanks, Frida.
So there's another question. If you give example 1 million for annuity, and then it finishes, the annuity stops or the investigation So monthly, so it depends on the annuity that you buy. There's an annuity that you buy until death, and it is just single life. So once I die, it stops. Whether if you give that 1 million to the insurance company, you die tomorrow, that money disappears. There's one that you would buy that it is you and your spouse. There is one that you would buy and it is a limited period of time. You say, I want this money for 10 years. So all those ones are available. It depends the risk that you want to take, and also that the risk that so the insurance company will do their variations and see what works. So whatever they give you and that whatever you buy, that is what you will get. So Esther, I've shared my number there, 0728 600 576. So I think in terms of James, I've not heard of anyone offering that as a retirement plan. In terms of biographies, if it so it's something maybe I can do work on to see, but I've not had anyone offering a solution of retirement plans using biographies. Not yet. Yes, insurance companies are the only ones who give annuity product. So obviously the equivalent of that would become an income drawdown. The income drawdown would now that's where you take your money, then that money is invested, and then you get a drawdown from that. So those are issued by different insurance companies. They are called income drawdown. So if it's an annuity, it is an insurance company. And the variations of that is an income drawdown.
We have Linda. Linda, go ahead.
Hi, so I have a question with regard to the tax benefits when you are contributing to a pension
Yes, please.
scheme. Is it, would you need to make the deposits via a certain channel in order to get these benefits? Or like say, if maybe I wanted to use a standing order to do the payment, how would I then get the benefits? Because how would it maybe when I file returns the following year, then I can say that I need this amount annually, I mean, for the whole year towards pension, so that then my tax, then I get a refund, or how exactly does it work? Or does it have to have come directly from the employer so that then, because from what I understand, the tax benefit is supposed to be deducted before the pay as you earn is calculated. Right?
Yes.
Yeah, explain that. I hope my question is clear.
The question is clear. So before your PAYE is calculated, then you deduct the amount of money that is going to the pension scheme. So it's as you file, I think these days as you calculate what amount you need to pay, the exact template that you have with KRA, so just input the amount of money that someone is deducted, and then it comes in upfront. So it goes as your salary goes, because the deduction, as you pay tax, it is deducted at that point.
All right, I think there's one question I could maybe read from the Q&A tab. Between using insurance companies or other retirement savings tools to invest for retirement and just investing individually using long-term tools for retirement, which one is better? With the exception of the employer matched contributions, where there is that obvious benefit, assuming someone can invest consistently and without withdrawing.
I think it's a combination of the two. So there is the insurance company there, and remember, these insurance companies also provide, depending on the product that you're looking at. If it's a pension product by the insurance company, should they have a minimum guaranteed return, and versus maybe I'm buying a policy, and yeah, all those things. So you need to look at the portfolio in totality and say, what exactly am I looking for? If I'm looking for a life policy, well, that is a risk management tool. either buy that or I go to the second level of I'm investing for retirement. So I'll go buy their IPP. But remember, as I do all this, the main conversation will be what part of my portfolio is this coming to take care of? Because I need to look at the liquidity that I require and what are the other options. So when it comes, if I need to buy a bond, what are the probability? What is the probability of me wanting to get that money back? So again, all these options that we have been going through, they play a slightly different part in your portfolio. So we need to look at that and say this is what goes where. So I don't want to answer and say this is the particular one, but we need to look at the portfolio and say what else do we need or what are we lacking.
Right. Thanks, Elizabeth. I think we can take one question. This is from John. It's on debt management. So John would also recommend that you go through the recording from session 1. But even this could act as a way of recap. So how do you come out of financial lockdown? This is you're surrounded by debt year in, year out. Again, which can be an impediment to retirement planning. So yes.
So thanks, John. I think what are the steps of getting out of a debt situation? One is accepting there's a problem. Once you accept there's a problem, let's document the debts that we have. How do you document the debt that we have? We just list them. We list the amounts, and then we list the rate that we are paying so that we are able to see our big issue. Then number 3, we need to understand how we got there. Even as we list this debt, let's understand how we got there. We could have gotten there by living other people's lives. You know, if someone has a problem and you go borrow on their behalf, so that mentally we work on knowing what triggers us to get to a certain situation. So once we do that, we now start saying, how do we pay this down? And yes, one of the ways is also to look at what is it that we have around us that we can be able to monetize. Maybe we have assets and those assets are not even yielding anything. Is it time for us to just sell them out? So John, those are some of the things that the conversation we would have. And my suggestion would be maybe you could book a coaching session with one of our coaches, and you'll be able to itemize and see what it is that that can be done. So there's a question where if I have 50,000 in infrastructure bond as a good saving, can you top up on it as you get money? No, the answer is it has to be reopened. So at times you might not be able to top up on the same, but you can buy the ones that are there in the market. Again, some of these ones are available in the market.
Great. I can see Timon as well. Yes, Timon.
Yeah, thank you for this opportunity. My apologies first. I have a bit of a flu, so my voice might not be clear enough, but I hope you'll be able to listen, to hear me clearly. First of all, I'd like to thank you all for the good work that you're doing in educating us on this. I was following up with your explanation, Elizabeth, and my question was, I was trying to just now to sign into the DAO CSD account, and at the bottom of it, there's a place where it says I need to select NSE broker. I'm a client of DTB. I do have an account with DTB. Me and my wife has a joint account. Is there DTB anywhere listed there as a stockbroker? Because I'm not seeing anything associated with DTB Bank there. So can you advise on what to choose there? Because I'd like to use DTB as my broker.
Manchi, I want you to answer.
Yes. Let me do this. Let me share a contact so that you can reach out to Mahmoud, who is our head of custodial, who can support now on that. I hope that's okay, Timon.
That's much appreciated. Thank you.
All right. I've just placed the contact. You can ask for our custodial business unit
Okay.
in the call. Yeah. Thank you.
And just maybe you can answer this. So must it be an individual account, or we can just use the joint account? Because I only have the joint account with DTB. The others are in my personal account, but are in different banks.
So I think when you open the DAO, it's either corporate or individual. I don't think it provides for two. I need to check. I'm not so sure. But Yeah. So, but if you go through Muhammad, you'll be able to open a nominee account, and that nominee account can be the two of you. I'm answering on his behalf, which I was
Yeah.
trying to avoid there.
Thank you.
Thanks, Elizabeth. Great. So I think you've answered so many of the questions, and thank you so much, Elizabeth. It's always a pleasure. I'd like us to wind up, and I know next week we have a session on planning for legacy. So maybe you can just give our participants a sneak peek, and that will be the last session actually for the year on personal financial management. And even as Elizabeth is sharing on this, and also, you know, one key takeaway from the session, I'd like for participants to share what they've taken so far from the trainings. I know at the beginning we had some answers coming in, but we would love to hear what has, you know, been your key takeaway, and what have you done different now, and any feedback really on the chats. We usually really appreciate and try to continuously improve the program. So yeah, Elizabeth, you can give us your, you know, the key takeaway for everyone and what they can look forward to next week.
Okay. Thank you so much, Mansui. What is the key takeout? The key takeout is we are in charge of our future. So and we should have gotten this information, I think, while in college or when in high school. But it's good that the DTB has taken it upon themselves to actually help us get this information, which helps us actually start where we are. So even as we think about where we are going, let's start where we are today. So we might say that maybe I'm in debt, I'm not supposed to start investing. Maybe start little so you can start learning. What is it that we are going to be looking at next week? We have learned all these things. We have started investing. We have money with GTB. But do you know that today we have over 84 billion in unclaimed financial assets? What does that mean? It means that people worked hard for their money, and even if they worked hard for their money, they did not involve their people that they care for or they were working hard for where the money is. So that money ends up in hands that in different places where they not to the people that they intended. So next week, we are going to discuss about legacy, and we shall be thinking about how do we want to be remembered, and what are the ways and structures that are available to structure our investments to pass to the next generation. So it is all about thinking about today I'm here, but when I'm not there, how will the world look like? That's one. Then number two, what are the structures that are going to help us in passing this legacy to the next generation? So that is generally what we shall be discussing about next week, Mansui. So happy to be here, and always thank you for sending us, for giving us good the feedback, the good, the bad, and the other thing is, please follow us. Have a lot of info looking at offshore investments. We shall be looking every Tuesday. We have come with questions, give us suggestions of what you also want to hear, and we want to grow together. And for those of us, there's a question that was asked: what can I learn? What are the things that what does it take to learn or to learn some of this? We also have programs at Zurich that helps you also get into details with this. And please subscribe to go to our website, go to our prosperity dashboard. Please start the work of setting your goals, start the work of managing your money there, even investments, and we will be happy to handhold you the whole process. Back to you, Mantui.
Thank you, Elizabeth. And as well on the DTB side, you can always tag us on your socials, Diamond Trust Bank, on LinkedIn, DTB Duo, everywhere else. Just highlight what you've learned. You can help one or two people. So thank you so much, ladies and gentlemen, as always, for the engagement, the participation. That's what keeps these programs going. So we will see you next week, the same time, same place, for the final module of the year. And a huge shout out to everyone who's been in all the sessions, including for our SME training. Thank you. And as always, we are open to hearing your feedback to know how we can improve. So see you next week, same time, same place.
Thank you.